Good morning, everybody, and welcome to today's meeting of the Local Pension Committee, which is taking place at County Hall in Glenfield. This meeting will be broadcast live via the County Council website and will be also available for viewing after the meeting. I've received apologies from Mrs. Wright, and I welcome Mr. Smith, who is acting as her substitute. I've also received apologies from Councillor March. So the first item, minutes of the meeting held on the 1st of December 2024. 2023 even. Yeah. I propose that the minutes of the meeting held on the 1st of December 23 are taken as read and confirmed and signed. Mr. Cartwright.
Thank you, Chairman, and good morning to everybody. I have a concern around the minutes as this. So I went on to the portal and printed it off as being AN other for any purpose of any person not involved with the committee. And I see the table motion I tabled is there. And then I go on to, it mentions that it will be deferred to item 12. Fine, no issues with that. Then item 12 doesn't appear. And it also, basically, it's lost from the comfort break onwards. So that's a concern. It's further implemented by, then I get the agenda pack for councillors, and it is there, excluding the comfort break, which was quite significant and would normally be minuted because no business was transacted during that time. These minutes are normally absolutely excellent and don't normally have reason to raise anything on them. So you won't be able to deal with this now, Chairman, but I think there might be a bug on the website that potentially for public viewing where it's got the incorrect version there for some reason. Not raising an issue with that, just if it is a technical issue, then it's something that needs sorting. But you won't be able to deal with that now. I don't want to bog the meeting down. But in terms of the councillor pack, it mentions my motion, which is fine, and then agenda item 12, which is there, which is great. But it omits the comfort break, which you can check back, and it'd be nice to have that inserted because it makes it a true and accurate record, which leads me on to being concerned that was then proposed, the motion was then proposed, and it was deferred to this meeting. I don't see it on the agenda, and with respect, I was copied into an email from Councillor Bill asking where it is on the agenda, and I'm not absolute. I didn't see the reply to that, so apologies if Councillor Bill had the reply, but I've not seen it. All I'm concerned about is where is that on today's agenda, because if it's not, if I'm not going to have the option to table that motion as I did, which we agreed, then I won't be able to vote for these minutes. You can understand why, sir.
Yeah, I can. So with those considerations in place, I propose that, taking note of what you've said, that the rest of the minutes are agreed. Is everybody in favour of that? Yeah? Are you in favour, Mr. Cartwright?
If I know where the motion I tabled is on today's agenda, yes.
Well, it is there. It is at the first under item. The first substantive item is the under item 6, where we consider your motion. So it's on from paragraph 20 onwards. We now consider the advice provided on the proposal put forward at the last meeting about fossil-free fund.
With respect, Chair, that's not the issue. I need to put the motion that we voted on before. It's called for all sorts of ways. That's my problem.
Okay.
Sorry, Chair. I think the Democratic Services Officer responded to Mr. Bill on this, who had made the query, to say that the report attached to the agenda makes reference to the proposal put forward in the introduction at paragraphs 2 and 9, and there's a specific section in the report which sets out the advice now received, which is paragraphs 20 to 46. The recommendation put forward for members to consider at the meeting is then set out at paragraph 48D.
Which it is. So it is there. It is there.
They could have in the first place and even needed to be counted. Devil in the details, not what was on there.
Well, I think when we get to it, your motion will be considered based on the advice that we have received from our advisors, which is clearly outlined within the report. All right.
We'll worry about it when we get there.
Yep.
I'm abstaining from the minute.
Okay, that's fine. So we'll note that. Mr. King, do you have something to say?
Yes, Chairman. Not what Councillor Cartwright's just said, but on page 13 of the pack, it's very clear. So what happened is there was an amendment was moved by Mr. Grimley, seconded by Mr. Harrison, that the proposal that you made at the meeting to establish a fossil fuel-free fund would be considered at this meeting. And as I understand, that is exactly what you've just said, and is in the pack, that it is being considered, not as what you'd expect as a motion, but as it is being considered whether that is something that should be considered as part of the strategy asset allocation. That's what we agreed through the amendment unanimously at the last meeting. We didn't say we'd bring a motion. We said we would ask the advisors to look into it and bring back a report.
So I think any reasonable person...
Just hold on a minute, Mr. Clark. Just hang on. Yeah, hang on.
Sorry, that microphone just went off. Don't know what.
The motion will be considered, or the advice that we've received will be considered. All right. So we...
I think any reasonable person would be expecting the motion to be coming to this meeting. I think the words "any reasonable person" are quite important.
No, I don't think so. I don't think so. I am not agreeing to take the motion. I'm agreeing to consider the advice, which we do rely on advice from our investment advisors. Unfortunately, we can't have just proposals coming forward. I don't want to invest in plastics. We have a duty, and if we get on with the meeting, no. We can't. This isn't not a political lobbying group. We're going to consider Mr. Cartwright's idea, quite rightly, and we will do. Right. Sorry?
Refuse to take a motion.
No, I'm not refusing to take the motion. It was clear what Mr. King had said. Look, I'm not going to go on this. We're going to get on with the meeting. Mr. Grimley.
Just to go on that, it was said that we'd take it as part of the report that was coming to the next committee on that. Whether or not the wording is correct in the minutes, I mean, that's something we do need to have a look at, but that was something that we did agree at the last meeting. I'm not sure whether you were online at that time.
Okay. Yes.
Sorry. So the report that you've got in front of you today that we're just about to move on to, paragraph 2, this report also provides advice regarding the fund's current investment strategy relating to fossil fuel exposure, and provides advice, as requested by the committee at the last meeting, on the proposal to require LGPS Central to establish a fossil fuel fund. That's paragraph 2. Paragraph 9. At the 1st of December 2023 local pension meeting, officers were asked to consider whether LGPCS Central should be requested to set up a fossil fuel-free fund. Officers were asked to investigate and present to the local pension committee its findings and advice on the matter. That's paragraph 9. And then there's a large chunk of the rest of the report that deals with the advice. And then in terms of the recommendations, it is at 48D.
Yeah. Okay.
So it is in the report.
So it is.
So.
Okay. Look, we're going to consider it. Right. So the next item is question time. I have received no question. Questions asked by members under Standing Order 7. I have received no questions. Item number 4. Urgent item. I have not been notified of any urgent items. So, declarations of interest in respect of items on the agenda. Do any members have any interest they wish to declare on any item on the agenda? Anybody got any interest? No. So the first substantive item on today's agenda is the overview of the current asset strategy and proposed 2024 asset strategy at pages 21 to 108 on the agenda. Now, before I hand over to the office to speak, I'd like to remind members of the clear legal advice the committee has received about its duties and responsibilities. The committee's power of investment must be exercised with care, skill, prudence and diligence, and its predominant focus should be what is best for the financial position of the fund, balancing risk and return. The pursuit of financial return is paramount and takes precedence over all other considerations. The primary objective is to ensure sufficient funding in the long term so the retirement benefits that employers promise to members under the scheme can be paid when they fall due. As long as this remains true, the committee's choice of investment may be influenced by wider social, ethical or environmental considerations, so long as this does not significantly risk material financial detriment to the fund, and where views on investment are likely to be widely shared by scheme employees and members. In addition, I would remind members that this is a legal requirement that proper advice must be taken before investment decisions are made. In this case of this fund, that advice must come from the fund's officers or an appointed advisor who will be FCA regulated. For the items on today's agenda, Hymans Robertson are attending as FCSA regulators advisors. So, the first item we have Bhulesh Karcher, Senior Finance Analyst, will first introduce the report. I would also like to welcome Mr. Philip Pearson and Mr. Russell Odes from Hymans Robertson, who are with us today to also present on this item. Before we begin, I'm going to suggest that we consider the outcome of the annual review of the fund's strategic investment allocation, and I will take questions and comments on this before we move on to consider the second part of the paper, which sets out the advice provided by our investment advisors on the proposal put forward by Mr. Cartwright at the last meeting. Bhulesh, if you can please present the report up to paragraph 20, that would be appreciated.
Thank you, Chair. So this is our overview of the current asset strategy and the proposed strategy for 24-25. I think we've covered the purpose of the report a couple of times, so I won't go through that. I'll get down to the summary of last year's strategy, and then I'll hand over to Philip. So I'll just draw your attention to a bit of background in points 6 to 8 of the paper. The SAA is considered with respect to central products, that's LGPS Central, the pooling company, and our commitment to pooling. Just a reminder that as at the 30th of September 2023, the value of pooled funds directly managed by Central and low-cost index trackers collectively procured from Legal and General totals 3 billion, or just over half of the fund's total value. The fund has significant uncalled commitments to Central illiquid products that, all things being equal, once called, will increase the proportion of pooled funds invested with Central. Any decision on the appropriate investment allocation is difficult and inevitably come down to a trade-off between risk and return. Whilst historic measures of risk and return can be informative of how different asset classes are correlated to each other, they give no guarantees that these historic links will persist. And 2022 was a reminder of this previously held belief and proven not to be true, as both bonds and equities sold off sharply. On to the review of last year's strategy. We'll talk about the progress made. I'll do a little summary of last year's SAA. So starting at point 10, we brought to the Pension Committee in 2023. There were no changes from the previous year in terms of percentages allocated to each asset class. However, there were a number of reviews that were recommended from last year's paper. First was a listed equity review. This was considered in April 2023 by the subcommittee and agreed a reduction from 42% of listed assets, total assets, to listed equity to 37.5%. What we then did was appoint a transition advisor, and that's listed, and their recommendations are listed in the bullet points. So 3 stages. You'll notice it says 4 stages there. Stages 1 and 2 were completed in mid-November 2023, by mid-November 2023, and stages 3 and 4 at the bottom of page 22 are yet to be completed. We're awaiting LGPS Central to agree a manager change for the Central Global Equity Fund. At that point, we'll consider the transition for that final piece for stages 3 and 4. Turning over to the next page, 23, points B and C outline the 2 other reviews. So the targeted return review was also taken to the ISC in April 23. As it stands, the reduction from 7.5% of total assets to 5% of total assets is largely complete. We've slimmed down the mandates. We had 3 mandates in that asset class. We've moved towards 2. The last review was a protection assets review. This was presented to the July 23 meeting as subcommittee. Hymans Robertson presented the case to reduce the allocation of index-linked bonds from 3.75% to 3.25, so a 0.5% reduction. And adding that reduction will be added to investment grade credit assets, pending their instruction on the relative pricing of those 2 classes. And at the time of writing, that hasn't completed. Hymans Robertson still believe that the timing's not favourable and will advise when the time is appropriate. Okay, to hand over to Philip here to talk about the 23-24 strategy, if there's no questions.
Thank you, Bhuvanesh. Has anybody got any questions? No? Yep. Nick.
Very quickly, on page 26, it talks about the SAA having an expected return of 8.7, which seems a very big number to me. It seems like a sort of, because of current interest rate scenarios or whatever, I'm suspicious of that number, quite frankly. I wonder how often that has been achieved in the last 15 years, and whether you consider that number is realistic, actually.
Let me take that one. So, we do believe it is a realistic number from where we stand today, which is the yields on government bonds that form the bedrock of most asset classes being relatively high. So we do believe it's realistic. That has been achieved over periods in the past, albeit less often when government bonds were a lot lower than they are today. It's an estimate which is what we call a median estimate. So there's a 50% chance of the returns of the fund being higher than that, and a 50% chance of them being lower than that. When we are considering what returns the fund might achieve for the purposes of arriving at the establishing your funding position, which would be usually my actuarial colleagues would do that, we take a much more conservative view of future returns. And in particular, we take the so-called 75th percentile return. 75th percentile return is one that we believe has a 75% chance of being realized, and that is significantly lower than 8.7. So I mention that because I think for what really matters, which is your funding position, we are assuming a more prudent estimate than is floated in the paper.
Okay, thanks for that. All right, so are there any other questions? No. All right, so Philip, if you carry on with the remainder of your report.
Thank you, Chair. We were going to do this in 2 chunks, actually. The first is to provide an overview of a few of the asset classes that are referred to in the strategy recommendations, recognizing that some of these asset classes have fairly technical concepts, and as ever in this world, they're fairly dense when it comes to terminology and jargon. And then the second part of the presentation will cover the findings and the recommendations of this year's investment strategy review. On the slide in front of you, on the screen, on the left-hand side, we've done a list of all the asset classes that we refer to in our presentation. And we have slides for each, which you're welcome to keep for reference. Don't have time to cover them all. I would just ask members whether there are 2 or 3 that you are particularly interested in learning more about, and I'll focus on them. If not, I'll pick my own three.
So,
any requests?
Zubair.
It's just the one that I haven't seen before. It's a bank risk transfer, or seen that one before.
Hey. Right.
I'm also interested in the infrastructure. So.
Okay.
So let me pick up those two, and I'll throw in a couple that are particularly significant for the recommendations this year. One of which is listed equities, and the reason this is significant is because it is so much of your fund. It's 37.5% allocation. Very simply, what you have here is ownership interests in large companies that are listed on stock exchanges worldwide. They're managed for you partly by Central, partly by Legal and General. Central do active management, which is where they are selectively picking stocks to try and outperform the index, considering a whole variety of factors, including obviously relevant to these days, the exposure of those stocks to climate change. And then Legal and General do passive management, which is where they pick all the stocks in the index. Even there, these days, climate change is taken into consideration. So Legal and General will run one strategy for you where they do invest in all stocks in the universe, but they weight the stocks and the holdings towards low emissions, low fossil fuels companies away from so-called bad stocks. The reason you invest in this stuff is to generate a positive real return over the long term, so above the rate of inflation, through a blend of income and capital gain, and where you earn a premium to the return that you would generate on government bonds. Hence, the yield on government bonds is so significant for longer term return expectations. Expected long-term return for this asset class just over 8%, but there are risks. The two key ones are business failure, in which case your capital would be first in line for loss, and the second one is market risk. So how richly the market is pricing the companies that you own. On the right-hand side, just an illustration of the sort of things that you are invested in. You'll see North American companies are a big slice of the total. You'll also see that UK companies, sadly these days, are a very small part of global capital markets. Let me touch next on infrastructure. So here you're investing in the equity of infrastructure assets or operating companies. So infrastructure assets are the facilities and the services required for the effective functioning of modern economies. You have a target allocation of 12.5%. And you invest with a variety of different managers. Here again, the aim of investing is to generate a positive real return over the long term, but crucially, a high proportion of those returns are generated in the form of income, which helps the fund actually to pay pensions. Some of that income is contractually linked to inflation. Also, infrastructure behaves quite differently to equities, and we've seen that over the last couple of years, which gives a diversification benefit. And finally, on this list, positive economic and social impacts from good infrastructure. It's a really important part of investing in this asset class, and parts of infrastructure are absolutely crucial to the decarbonisation process. Inevitably, there are a range of risks, and I've listed some on the slide in front of you. This slide is just gives you a flavour of the enormous diversity of different asset classes that infrastructure covers, and which you will be, through one or other of your mandates, invested in across transport, energy, including renewable energy, utilities, telecoms, and social infrastructure, schools, hospitals, and the like. Unless there are any questions on that, I'll pop it. Yeah, sure.
Infrastructure and equity, in terms of the equities being the secondary market and the infrastructure, that more direct application of monies into sort of real life, sort of real world projects, that kind of impact, and hence why in the infrastructure space, not sort of into sort of, I don't know, not investing in sort of oil and gas companies, well, we might do in sort of secondary markets with the equity, sort of difference between the two classes.
That's a very good question. I think the key thing with this asset class is that you are generally invested in very specific assets. So you know, and in particular the managers that invest on your behalf know precisely what they are investing in. So it could be an electrical transmission line, or a particular set of rolling stock. So you're very much focused on particular assets. Whereas when you invest in listed equities, particularly the very large companies in that space, they will have lots and lots of different businesses in all sorts of different sectors, using all sorts of different assets. So it is much harder to understand, let alone to control, what impact those investments will have. Infrastructure is a great asset class for being able to control what impact you're having on the wider world, economic, social, or environmental.
Thank you, Philip. Mr. King.
Yeah, thanks for that. I think that just so I attended the LGPS conference last week in York, and there was a presentation by officials from the department for Levelling Up, and just talking about the outcome of their consultation. And I'm sure you'll be aware of this, but I'm just wondering how we're factoring this in. Which the two things that they talked about quite a lot was the funds to set up a plan to invest up to 5% of assets in projects which support levelling up, and also an ambition to invest 10% of our assets in private equity, which I note that we already got, just slightly nudged over that 10%. So I'm just wondering about this 5% issue and how in the future investment strategy we're seeking to discharge that, or have you not incorporated that in at the moment? And that's something that, because it only got announced a few weeks ago, well, a couple of weeks ago, something. So is that something we're going to have to do sort of in the future? Thank you.
The aspiration was announced it's actually a few months ago now, but it is still relatively recent. But investing in projects that will contribute to levelling up is absolutely not new for the fund. And infrastructure is a very, very good example of that. So most of your infrastructure mandates are global mandates, but they will include a significant allocation to the UK. Because the UK punches above its weight in terms of share of the global investable infrastructure market, and will include projects, assets within the UK in these sorts of asset classes on the screen. Our current approach with the SAA is not to carve out a dedicated levelling up allocation and start moving capital into that allocation. Rather, it is to say, let's understand where all our existing investments are, and which obviously are in the UK and which are contributing to levelling up objectives, and make sure that we're doing an appropriate amount, both in the context of that 5% ambition, but also in the context of the fund's wider objectives, which is to deliver financial return that gets pensions paid. And we're going through, or managers are going through that process at the moment, understanding what the levelling up type impacts of all the existing investments are before we decide what else, if anything, needs to be done. The view is, certainly from LGPS Central, that they are comfortably over the 5% already.
Yeah, come back, please, Mr. King.
Yeah, thanks for that. So, how is it going to be reported in to us then? That's the requirement, isn't it? It's got the government's looking for it to be reported as part of the. It's obviously your guys, your team are looking at working all that out in detail. So at some point we're going to get a report outlining that. What's the sort of expectation in terms of timeline? And keeps going off.
I'll take that. So I think last year we took a report to the investment subcommittee outlining of that 12.5% allocation to infrastructure, how much was allocated to various geographies. We took a framework that was approved at ISC, and we'll keep reviewing that framework targets versus our actuals within infrastructure. The kind of areas that you can invest in that are deemed levelling up are really wide. Practically, you can almost say that anything we will invest in terms of infrastructure will touch one of those. Was it 12 CAT? Said 12 levelling up. Yeah, there's 12 levelling up areas. So, we can touch practically all of those, but it's for officers to reach out to our managers, find out how much we've got invested in various geographies, and then report back. And there's some additional guidance yet to come from government as well to tighten that up for us.
Okay, thanks. Thanks, Mr. King. Mr. Bill.
Thank you, Chairman. I'm a little bit concerned about this reference to levelling up for investment. The impression I've got is that levelling up seems to involve cancelling major projects, very little in the way of actual tangible projects that we can, unless you include tarmac for potholes. I'm looking at this layman, just observing the scene. Policy seems to change from day to day on. Seems to be a very dangerous area for us to consider confidence of project. On that.
Yeah, sure.
Very happy to take that one. I mentioned that managers are figuring out what the impact levelling up wise is of the investments they've already been made. And it is very much that way round. Your managers will not invest in things predominantly or primarily because they help levelling up from a political perspective, and nor should they. They will invest in things that they believe are going to generate the fund a decent financial return. They'll also be very wary of investing in projects that look vulnerable from a political perspective, vulnerable to a change in policy. But certainly, if they find opportunities that offer an attractive financial return and have good positive economic and social impacts that could contribute to a levelling up policy and set of levelling up objectives, then yes, they will invest, and they will, in the fullness of time, be able to report on the impacts that they've achieved. But it is very, very much that way round. I would suggest that's the right way round.
Seems sensible to me.
Yeah, just another question on the levelling up agenda. But so in terms of levelling up for the, does that in terms of geographies covered, would that levelling up agenda be part of the wider levelling up agenda across the UK, or would there be ambition to try and do something around Leicestershire and the Midlands region?
So most of your mandates are global mandates. And rightly so, because that gives your managers the widest possible opportunity set, so they can, in theory at least, choose the best investments for you. They then choose what they consider to be the best investments. If those investments are in the UK, that's fine, good contribution. If they happen to be in Leicestershire, even better. But it's always driven from where do they think the best risk-adjusted return is. So all I think I would suggest to someone who is looking to sponsor a project in the Leicestershire region is develop the best possible business case for your project or your company or your asset, and make that opportunity known to the fund's investment managers, and they would be delighted to consider it. And I promise you there would be, because one of the big challenges of putting money to work in things like infrastructure is originating good investment opportunities. Astonishingly, there isn't enough to go around.
Thanks very much. That's good to hear, Philip. Sir Nanny.
Yes, thank you, Chair. I just wondered to what extent you try and accommodate geopolitical risks. The Red Sea is a hot potato at the moment. And I wonder what sort of balance of our investments are in the BRICS economies overall.
We do, and again, crucially, your managers are very sensitive to a whole wide range of risks. Two of the key ones at the moment are obviously climate change and geopolitics. There are steps they take to sidestep some of those risks, although completely sidestepping the impact of what's happening in the Red Sea at the moment is, you appreciate, is difficult given the importance of that trade route. The other thing the fund does is diversification. So we are trying for as broad a possible diversification, both by asset type and also geography, in order to mitigate the impact of any one particular risk, like what's happening in the Red Sea. In answer specifically to the question about exposure to the BRICS, your direct exposure to emerging markets is relatively small. I forget the exact figure, but it'll be well less than 10% of equities, and even lower of the other asset classes. And BRICS are only a part of broader emerging markets. So it's a relatively small direct exposure, but as we may touch on later on, the indirect exposure of difficulties in China, for example, which is a small part of global capital markets, but a big part of the global economy, that is really difficult to avoid.
Great, thanks. Mr. Grimley.
It's just a quick one about the levelling up. I think Mr. Bill was a bit sort of sceptical. I just did a quick Google search. It reminded me, obviously, what one of the ones going ahead and the levelling up is the Leicester Railway Station. I think that's being redeveloped about the fourth time in my sort of living memory. So there are these things are going ahead. There are probably smaller scale ones that have lots of certainly I know. I think there's also others going around in Charnwood, and just need to double check, but recency I'm fairly sure in Bursa in my patch shows part of levelling up as well.
Right, thanks for that.
This first section of the presentation, just by briefly covering the bank risk transfer asset class, which was flagged as an area of interest. So this is actually a relatively small, very specialist part of your portfolio. It's part of the 1% allocations to so-called special situations credit. And what the manager is doing on your behalf here is ensuring the first losses, or in some cases the second losses, on portfolios of loans originated by a number of different banks. And by ensuring the risk on those portfolios, that allows the counterparty banks to reduce the amount of regulatory capital, which is very helpful for them, and in return they're happy to pay you a really decent return. So the target expected long-term return here is 10%. The reason you invest, aside from that interesting investment return, is that an awful lot of the return comes in the form of income, and also, particularly because of its specialist nature, there's really strong diversification versus your equity portfolio. There are definitely some risks. So firstly, the risk of credit default by companies in the underlying portfolios, and that's exacerbated by the fact that you are structurally subordinated. So you're in a junior position in the capital structure, which means you will take, as I say, either the first loss or the second loss in the event any of those underlying companies that the bank has lent money to, in the event that they default. So this is relatively high risk within the credit market. Other risks are adverse selection. Essentially what this means is the bank's underwriting has gone wrong and they have picked companies that are more likely to default. Clearly they try not to, but that is a risk. And finally, illiquidity. So the contracts that the manager enters into to provide this insurance can't be exited and very difficult to sell them. So you are really locked into this position for the length of the insurance contracts. So there are risks, but you're getting paid a decent return to compensate you for them. The chart on the bottom right just gives you a flavour of the sort of things that you're invested in. So about half the portfolio is small and medium-sized company loans. You've then got some mid-market company loans. You've got some residential mortgages and consumer loans, and then various other bits and pieces.
I was just going to say, is it worth adding any background to the two mandates that we have used with CLC and how long the education, the sheer number of loans?
Yeah, so you actually invested in two vintages of funds created by the manager that works for you here. They're called CLC. The first of those vintages was set up quite a few years ago now. I forget quite how many, and the manager has been entering into these insurance contracts with dozens of different banks over the intervening years, and the portfolios that they insure include certainly tens, probably hundreds of individual loans. So you are extremely well diversified in terms of the individual underlying credit risks, particularly because a lot of the portfolio are small loans to small and medium-sized companies.
Okay, thank you.
So that's it in terms of bank risk transfer. Hopefully that's a bit clearer. Are there any more questions on either what I've presented or other things people have spotted in the papers around individual asset classes.
Mr. King.
Yes, thank you, Philip, for your presentation. Very helpful. But I just want to go back to what you were just talking about a few minutes ago about the infrastructure investments, and you mentioned that fund managers, that I presume that's Central, you said there's a paucity of suitable quality projects to invest in. So what I'm wondering is, what are Central doing to basically inform the marketplace, if this is local, kind of UK-wide, to inform the marketplace of the sort of quality of projects that they are looking for? So, because it's a two-way process, you can have the funds to invest, but you're saying there are things coming forward, well, how do the people who need to bring those things forward understand what the quality of the proposition is that they need to have? Otherwise, you can't, there's no. So I think it's kind of, it's a two-way process, and I'm not very clear at all how our manager, how Central are actually, engaging with potential kind of promoters of suitable projects to kind of make it clear to them what that quality, what sort of projects they'd be interested in and what scale, and B, then what the sort of, kind of expectation, return and all those sorts of things would be. Maybe you could just explain that a bit.
No, sure, absolutely. So it isn't, the first thing I would say is not just Central. So Central invest in underlying funds run by a range of infrastructure managers. And then you're already invested directly with 5 existing managers yourself. So there are, working on your behalf, a large number of infrastructure fund managers, and they spend an awful lot of their time talking to companies that need to develop infrastructure, talking to specialist infrastructure developers to make it clear what sort of projects are interesting in terms of the different parts of the infrastructure market, what sort of risk return profiles are interesting, what risks are acceptable, what risks aren't acceptable. So yeah, they spend a great deal of their time setting expectations of what would constitute a good investable infrastructure project. Going back 10, 15 years ago, that's all they did. And they gradually got pretty frustrated with the progress that they were making on that. So over the last 5 years, certainly, a lot of infrastructure managers have moved into developing the projects themselves. They will go out and look for infrastructure needs, and they will develop projects to create new infrastructure. They will take those through projects through the painful process of planning and raising all the different finance that you need, and then they will project manage the construction. So that's been a real theme of the last few years, is infrastructure managers actually doing something very proactive to deal with the issue of a lack of supply.
Thank you for.
I can just come back. Yeah, thanks for that. I don't know why my microphone keeps going off, so apologies for that. So that's really helpful. So that then comes back to what we mentioned earlier about understanding what are those projects that we're currently or are invested in or have been invested in. So we actually understand that a bit clearer, because at the moment I've got no idea what projects our fund managers have actually invested in to deliver those things, which are great, but we've got no idea what those things are necessarily. Thank
you. Look, I mean, there's the managers produce extremely detailed reports on what you're invested in, down to the individual asset level in some cases. So I'm sure it would be possible to pull up from those underlying manager reports more granular reporting on what you're actually invested in. The one area that I think does need more work, which we touched on earlier on, is measuring the economic and social impacts of those projects and whether or not they contribute to things like levelling up. So that will need more work. But the nature of what you're invested in at a more granular level, the information is all there. It's simply a question of summarising it.
Okay, thank you for that. Right, so I'll take one more question. Mr. Bill.
To appear a bit cynical, Chairman, but I've been here a long time now, and I've attended so many government-based presentations on what's going to happen and what we should be doing, only to find these things just crumble away to dust. HS2, we attended a whole range of presentation meetings where we were told this is the way forward, this is where we've got to invest all our thoughts and activities and money and all the rest of it. And I don't know how much money has been invested by various companies in this project, both in terms of the immediate infrastructure and the supply lines and all the rest of it. But in the flick of a switch, the whole thing is turned off. So someone must have lost a packet of money somewhere. But when I hear this term levelling up, which to me is only a campaign slogan, very little behind it that I can see. I mean, all right, yes, we're going to put some money into Leicester railway station again, which is great, but we've heard that story so many times. It just changes and it's put on hold, and then it's put back, and then not going to do it at all. I just have this. I've seen so much, which government after government and council after council build up hopes of things are going to happen, and then all of a sudden, inflation overtakes us and all sorts of other issues, and nothing happens. So I just hope that your confidence that it's all going to come right is based on it's true. But I've just got that cynicism in me, I'm afraid, where I've seen so much go wrong. Yeah, in fact, what people tell me out there is nothing is working.
Yeah.
So it's. But perhaps you've got the answers to all these problems.
No, I think to be honest, Philip sort of said that the evaluation of each investment scheme, the paramount importance is that we are producing return for our pensioners, and that they will not be guided by political motivations or anything else like that. Our investments will be sound per se, irrespective of what the government says. Correct me if I'm wrong, Philip. Is that right?
That's absolutely right. And you, I think you should be reassured that all your managers, and including your infrastructure managers, are pretty sceptical as well. And having read from cover to cover the original HS2 business case, they've got every right to be sceptical on that grounds. Yeah. So skepticism, really important. You have people who are being skeptical on your behalf, and they are focusing on making money for you.
Yeah. Okay, John. Look, I don't think you're alone in being skeptical, Mr. Bill, and that's why we have investment advisors. Nick.
Very quickly, talk about reviewing the sort of funds allocation, particularly sort of reducing the risk profile within that, which I think is a very good idea if we can within that. What's the sort of timeline on that, and what sort of things are you considering effectively within that?
May I come back to that, because we do actually address that very specific point in the next half of our presentation. So
okay, all right, okay. So we'll move on. Right, Mr. Clark. This is the last question I take. All right, I said that 2 questions ago,
yeah,
but this
I'm
is
really
the last one.
I'm really grateful for your generosity. I'm just interested to know, and I know reasons why we might not, but to know to what degree we look at what other funds and pools are doing, how we juxtapose our decisions against those and measure them as benchmarks, against benchmarks.
We do keep an eye on what other funds and pools are doing, but honestly, yes, absolutely. But honestly, we try not to be too influenced by it, and the reason is that every fund is different. In terms of important things like your funding position, your risk appetite, the ability of sponsoring employers to flex contribution rates down, obviously, but also up. So it is really, really important that the funding strategy and the investment strategy reflects your needs, not the LGPS average. Having said that, there's an example that we'll come to today on the subject of de-risking, where we've looked at increasing the allocation to protection assets, which means a reduction to return-seeking assets like equities. And one of the things that we are aware of there is that your allocation to equities is already around the level that a relatively well-funded reason to go further. So yes, we do take it into account.
So, to what degree have we looked at the Border to Coast Climate Opportunities Fund, and how do we monitor that progress?
So I have clients who are in Border to Coast who are invested in that fund. We regularly do reviews of that strategy. In fact, we're currently doing a review of that strategy ahead of the launch of the second generation of that fund. It is an interesting proposition. They're doing, they've approached the issue in a slightly different way by creating a fund that is dedicated to climate opportunities. Central are doing it in a different way, which is to invest in decarbonisation opportunities across a number of their different funds in different asset classes, in their infrastructure fund, in their private debt fund, and so on and so forth. So the two pools are approaching it in a slightly different way, but it looks like they're getting to the same place in terms of the sorts of assets they're invested in, and the progress they're making investing in companies that either have very low emissions, which is obviously good, or companies that are producing products and services that will help others with the decarbonisation process. Both Central and actually particularly Central, even more, Central can demonstrate better progress on climate change in the way they're doing it than Border to Coast can today.
Okay, thanks very much for that. Thank you for that. So we're now going to move on to the next section. So moving on to the remainder of the report from paragraph 20 onwards, we will now consider the advice provided.
Not quite finished on the 2024 strategy, still to come. No.
I'll go straight. Yeah. Okay. So I'd like now to move to the second half, which which hopefully will be more straightforward. I promise, Chair.
Yeah.
So this is the findings and the recommendations of our annual review of strategy and structure, divided into a number of sections. Quick look at the market, quick look at the current strategy and the projected returns, and then the findings on the different asset classes. Brief look at the market, starting with growth. Growth last year did surprise to the upside, but nonetheless, growth rates are now falling, and we expect the fall to continue into 2024 for all the reasons that people are very familiar with now. Inflation, mercifully, is falling pretty quickly. We think that will continue, but we do think that there will be a persistent rump of higher inflation, which will take longer to clear, and that's a lot to do with how high core inflation is and how high wage inflation is, particularly in the UK, which you'll see is an outlier in the green line on the chart on the right-hand side. That high inflation obviously meant that interest rates had to rise. Markets expected interest rates to remain high. Expected interest rates is what drives the yields on government bonds. And so unsurprisingly, government bond yields rose through much of 2023 in all markets, and you'll see the chart on the left-hand side. Government bond yields have been falling for the last few months as markets expect economies and central banks to start reducing interest rates at some point in 2024. And the chart on the right-hand side tries to show that expectations of how far and how fast interest rates will fall during 2024 or by the end of 2024 in the green line, and by the end of 2025 in the red line. Expectations of how far and how fast they'll fall have increased over recent months, which is all generally good for asset markets. Global equities did have a bad patch last year when corporate earnings were struggling, but have had a good performance over the last 3 to 6 months, largely on the back of lower than expected inflation and that decline in sovereign bond yields, particularly in the US. It's not separated. The US has done particularly well, and Japan. Sorry, on the right-hand side, US in yellow, Japan in pink. So, what does that mean for the asset classes that you're invested in? A mixed bag. So, focus on the column on the right-hand side, which looks at returns over the 15 months since the fund's last valuation in March 2022. And you can see that equities managed to post a small positive return, but property, index, inflation-linked gilts, and investment-grade corporate bonds all posted severe losses on the back of that increase in government bond yields. So diversification certainly helped you here, being invested in a whole range of different asset classes, a whole range of different economies. But nonetheless, the fund's net overall return since the last valuation is minus 1.9%. Clearly not where we'd want to be. And crucially, it's quite some way below the 4.4% required return assumed in your funding level. Looking at the current strategy, which, by the way, is also the proposed strategy, because we are not recommending any changes in the SAA at this stage. You'll see the current strategy is 50% allocation to growth assets like equities, which deliver a positive real return, 40-odd% allocation to income assets, which also are designed to deliver a real return, predominantly in the form of income, and also to diversify your equity risk. And then those protection assets, which are designed, believe it or not, to reduce the level of investment risk over time, but also to match the fluctuations in the fund's liabilities. You are diversified. When we set the level of diversification, we're juggling a really delicate balancing act. More diversification, generally good in terms of reducing risk, but too much diversification is not good because it brings extra costs and complexity. Headline, though, is we're not proposing at this stage any changes in strategic asset allocation. And that may be a surprise. In particular, you may be surprised that we haven't proposed a further de-risking, given the improvement in funding position, given the fact that those protection assets are a lot cheaper than they were 2 years ago. We have very carefully considered the case for de-risking, and we're still considering it. We're still doing analysis on the opportunities. But at this stage, we don't believe there is a case for de-risking, and we'll touch on some of the reasons why on a later slide. I will just talk about projected returns, even though we've already covered that. So the latest projection of returns, the median projection, so 50% chance of exceeding this, 50% chance of falling behind it, is shown in the column on the right-hand side. And you'll see that nets out to an 8.7% return for the current strategy overall. That is significantly higher than it was at the last valuation. And that is almost entirely due to the fact that the current yield on government bonds, which acts as a bedrock to the asset class returns on all asset classes over the long term, is quite a lot higher than it was 15 months ago. So that's it in terms of the headline, no change, but we do have some recommendations for you, and I was going to hand over to Russell just to talk us through those.
Yeah,
thank you.
Over to you, Russell. Oh, hear me all right, do you want to? Yeah, so a couple of slides ago, Philip gave away the answer to the slides that follow. So thank you, Philip. But it's essentially maintaining the target allocation at this stage, but it's a little bit more than that. There are a few recommendations in here. About a 70-page report just to say that one sentence. So I'll take you through a few of the key highlights by asset class, starting with the growth assets. So as Philip said, largely equities. On the listed side, as Philip mentioned, these have delivered strong returns over recent years, and particularly last year, perhaps as a bit of a surprise given the expected recession that didn't come. But we're recommending that the target allocation is maintained, 37.5%. We're a little over that, as was mentioned earlier. Work is going on at the moment to bring that to the target allocation as private equity. So this is companies that aren't listed with a very strong returns again, particularly in the post global financial crisis period. We don't necessarily expect those really strong returns to continue going forward, but we still expect a good return, and particularly a premium of the returns that you listed equities. So again, we're recommending that the 7.5% allocation is maintained. To maintain that allocation, you need to make further commitments in order to keep that at 7.5%. This is because some of these funds are closed-ended, they return capital over time, so you need to reinvest, and also the fund's growing. So to maintain a steady 7.5%, you need to continue to allocate, and those further commitments have been in the last few months to maintain that 7.5% weighting. Targeted return. So this is a slightly different approach to generating growth. A range of diversified types of growth investment. Perhaps won't deliver as strong returns as equities when things are flying upwards, as we've seen over recent periods, but provide more downside protection when things are looking concerning. The performances of the current holdings has been mixed, but as I say, if problems in turbulence in the road ahead, then we might expect these to perform better than say the third listed equities. So again, we're recommending the target allocation maintained at 5%. Work's currently ongoing, as was briefly mentioned earlier, to restructure that portfolio from 3 managers to 2 and cut the allocation down to 5%. And if everybody's happy, onto the income assets. So we've touched on infrastructure as an asset class. Again, maintained at 12.5%. But in order to achieve this, you need new commitments. One, we're currently underweight relative to the 12.5%, and two, again, there's some closed-ended investments returning capital in there. So in order to maintain the target allocation of 12.5%, we're recommending considerations given to what additional commitments are needed over the next 3 years to reach that allocation. We're suggesting a review of that over the coming year to see what's needed in terms of commitments to get the desired profile. And also similarly on the Timberland funds from Stafford, money's coming back from those vintages. At the same time, there's also a suggestion of an open-ended product where you don't continually need to reinvest. That's done within the fund. At the same time, we're recommending that consideration is given to that version. Property, briefly touching on this, again, recommending this is maintained at the target of 10%. We remain comfortable with the structure in terms of how that's intended to be achieved. For the time being, some money is due to be returned from the Aegon funds in this area, and we're recommending that some of that is reinvested with LaSalle, but that is in line with previous recommendations. Skipping on to the high yielding credit, so 2 areas here. We've got the liquid markets, which I'll touch on first, and then the illiquid ones follow. Liquid side, we the multi-asset credit fund managed by LGPS Central, and the remaining emerging market debt allocation, although that's due to be divested as part of the restructuring process. We've previously recommended that MAC is increased from what's around about 4% at the moment to a 9% allocation. That decision to implement was deferred whilst we consider our tactical view of and our future short-term outlook for that asset class, and also the suitability of the central product, and it was a relatively new product at the time, and we suggested that further increased confidence was gained in that product. We've reviewed this position again, and we've concluded that 9% to MAC in general remains appropriate. The LGPS Central product is a suitable investment, and also, but at the same time, our short-term view on this asset class, high yield credit, is remaining cautious. So what we're suggesting here is that you proceed with the implementation, but it's done over phases over the course of this year, four phases, in order to mitigate that market timing risk. Each stage we'll consider whether our tactical view of this asset class support investment at that time.
Okay, so has anyone had any questions on this? If not, we'll move on. Kabir.
Am I right in comparing the minus 1.9%? Is that comparing like with like?
One's one is backward looking and the other is backward looking fact and the other is forward looking estimate. But essentially yes. But I think the real comparison should be with the required return of 4.4%, because that is what the actuary assumes in arriving at your funding position. So the crucial thing is how well are we doing relative to 4.4? So clearly the last 15 months have not helped. If the fund does deliver 8.7% on average over the next 20 years, that would be a great result. It will not deliver 8.7% every year, of course, but on average, that would be a fantastic outcome.
Okay, thanks very much. So, have I got any other questions? Yeah, Nick.
Yeah, I'm a lot more comfortable about having to achieve 4.4 than 8.7, I have to say. In terms of going back to my original question, in there, in terms of the protection assets that you were talking about, reviewing that and de-risking within that, what are you like? Are you likely to sort of change that going forward?
And also why at the moment we've concluded that it would not be appropriate, but we are still doing some more work on that. But let's tell you where we've got to.
So that is thanks for that's 2 slides on. So yeah, we considered the protection assets in quite a lot of detail as part of this review. These assets are invested into to control investment risk, but also to mitigate the impact of changes in the value of the liabilities. So liabilities are linked to expectations for future interest rates and inflation. These investments, the investment grade corporate bonds and the index linked gilts that you invest in the protection assets, they're also sensitive to the same things, so they move in the same direction as your liabilities do. What's happened over the last couple of years is interest rate expectations have flown up very quickly. 14 years of falls effectively were wiped out within 9 months or so, and interest rate expectations have remained higher today, a lot higher today than they did say 2.5 years ago. So we've seen the protection assets fall in value quite materially as we before, but you only invest say around 8% of your assets in these investments. All of your liabilities have fallen by the same percentage amount, so your liabilities will fall a lot further than your protection assets have done in pound amount terms. That's why you'll have seen funding position will have improved quite since your last valuation point. So is that an opportunity to potentially increase the allocation to protection assets? It's certainly worth asking the question. The funding position is a lot stronger. Should you protect that to a greater extent? And our initial analysis in that area does suggest that an increase may be justifiable, but not quite that straightforward. The analysis that we've carried out is quite approximate and high level. It doesn't consider both the assets and the liabilities in full detail, which is what you should do if you're considering increasing these protection assets. The whole point of increasing them here would be to protect those liabilities. We want to ensure that we're getting that right. The modelling that we've carried out isn't detailed enough at this stage to do that. And also there are other considerations, such as the fact that you maintain a high weighting to growth and income investments rather than investing in protection assets to keep that expected return relatively high, to make sure that you fund your future service liabilities, so the new accruals coming in to ensure that the assets you're invested in are doing the hard work. Otherwise, contributions might have to increase. We haven't assessed that really important part of this review. At the same time, as Philip mentioned earlier, your current exposure to growth and income assets is about the levels that you might be expected to be at, say when you valuation point and you were in a small surplus position at that point. So you're probably around about where you might be expected to be in terms of your weightage between these different areas. But at the same time, that surplus has grown quite materially. So the investments in justice are. So what our recommendation is, in a nutshell, is that we validate this view that protection assets could be increased by carrying out some more detailed modelling, which will give us a more precise idea to the amount that they may be increased by without causing any adverse effects on say, rates. So we're proposing that's carried out in the first quarter of this year, which of course we're already in. The idea being that this is essentially a bit of a market timing opportunity. We've seen interest rates expectations fly up far quicker than everybody expected. How short or long lived will that be? Nobody really knows. If we delay too long in terms of looking at this and deciding what to do, there's the potential for that to reverse back out again. So we're proposing we take a more detailed look at it, some more detailed modelling, and do that.
Okay, report back to the next meeting.
We're going to report back at the April investment subcommittee meeting.
Okay, all right. So it's a very involved report, a very important report, probably one of the most important reports we have all year. Has anybody got any other questions? No? All right. So we will then move on to the second part of the report. So moving on, the remainder of the report from paragraph 20 onwards, we will now consider the advice provided on the proposal put forward at the last meeting to require that LGPS Central establish a fossil fuel-free fund. Be clear, all we're able to do as members, if members are so minded, to support Councillor Cartwright's proposal is to request LGBS to set up a fund. We cannot require them. To make this clear, so far as the recommendation of paragraph 48D is concerned, therefore, I move in the first instance that line 2 be amended to read the proposal to request LGPS Central to establish a fossil-free fund. Do I have a seconder? Thank you. All those in favour? You can talk to it. Please do, Mr. Cartwright.
Thank you, Chairman. I want to make it clear. It's not, so we don't need to get bogged down in the minutiae of this. But what I'm failing to understand is, and I talked about it right at the end in the summary to make it absolutely clear, and apologies if it didn't come across as clear, because I had no wish to achieve that outcome. Because the request, if you like, using the terminology you'd like to use, which I don't have any issue with, was simply to add a line in the funding that allows for it to be specifically fossil free. And the rationale behind that was explained in the motion, what I thought was perfectly clear. And that was that it gave companies and funders the choice to be aligned to that or not. Now, if Mr. King was right, or is proven right in the fullness of time, that climate change is all a load of nonsense, then nobody would want to go into that fund. And I don't have any issue within 10 years' time, that fund having nobody into it. And what I requested was simply the ability to have choice and clarity. Nothing more, nothing less. It was very specific that said, I do not want any changes to what we're currently invested in whatsoever. Just an extra line that gave the structure of the whole scheme the opportunity to be aligned to that should the really struggling to understand how giving a choice without an obligation is so controversial. Thank you, Chairman.
Well, first of all, what I would say is I don't think anybody thinks climate change is a nonsense. And in honesty, having read the reports and everything else, I think we will have a report coming forward in the next item to show where we are. And certainly carbon reduction is a primary concern of everybody here, not necessarily for our generation, but for future generations. So look, let's just go through it. I've made a proposal to request that LGPS to establish a fossil-free fund. I've got a seconder. Is that agreed? Yeah. Okay, so that is agreed. So let's I'm very keen to ideas to be put forward, but let's just hear the rationale behind what the recommendations are. I don't think anybody's saying what you've put forward, Mr. Cartwright, is outrageous. Far from it. But let's have a look and see what our investment advisors say and the reason behind them.
I'll take this one, Chair. So, Mr. Cartwright, coming back to the original request, I think we've highlighted it, points 30 and 31 of the paper, and I'll read them out just for clarity. It's important to note that requesting Central to build a new fund is expensive. It's an expensive exercise, and one which all partner funds would need to pay for. So we're one of 8 partner funds which fund LGPS Central. This method to develop investment products at Central requires a known demand for an investment product before costs are incurred. Partner funds are aligned on their approach undertaken by Central in the provision of climate tilted funds today. Well, we can talk about what a tilted fund is in a moment. The cost to develop products is shared under a cost sharing agreement. It's a legal document signed by all the 8 administering bodies. Central would be hesitant to develop a new product without enough investment funds being committed at the outset to commence any feasibility work, given the cost implications to other administering bodies. The cost would not be insignificant in developing a new product, and implications on other local authorities could place a strain on our relationships with other funds and our partners. It's probably a good time to just talk about the tilted method that Central used to achieve their carbon reductions. Luke, do you want a couple of words versus an exclusion rate?
Yes. So, and perhaps also I might say something on the sort of overall structure of the fund that I think is relevant here. But just to comment specifically on the approaches that your managers currently employ around climate change. They're all based on one core principle, that it is better for the fund and actually better for the wider economy and the climate, that institutional investors like the fund should remain invested in companies that have high emissions or have fossil fuel reserves, and should engage very firmly with those companies, make sure that the companies in question have plans to decommission fossil fuel assets to reduce emissions, and to remain engaged as long as it makes there is a strong financial case for remaining invested in that company. Now, the different parts of your portfolio do that. In the case of your traditional passive funds that are required to hold every company in the index, what the manager there does is focuses on engagement. So Legal and General is meeting regularly with the companies in the index to make sure that they have got sensible decarbonisation plans and they're delivering them. The second approach is what we call the sort of tilted index approach, which is where the manager is invested in all companies in the index, but they reduce the weight to companies that have high emissions or high exposure to fossil fuel reserves. And in certain cases, like thermal coal, they will actually exclude those companies altogether from the index. So that is sending a strong signal to the companies in question that if they want the maximum amount of capital from capital markets, they need to do something about their emissions and their fossil fuels. The third way is what your active managers do, which is they make decisions on individual stocks. They don't have to have everything. They don't have to own everything, and they don't. But they make decisions on each individual stock, take into account a whole variety of criteria, including exposure to climate risk, but also prospective investment returns. And they choose companies that offer good prospective investment returns and a responsible approach to managing climate risk. So you have those three different mechanisms at work. In aggregate, they are very successful. So the emissions of your fund, greenhouse gas emissions, and the exposure to fossil fuels have fallen over time. They've fallen faster so far than they need to hit the fund's net zero objective. And also the current levels of both emissions and fossil fuels are way below the asset markets that you invest in. So one of the reasons for not recommending changing the approach is that the current approach is working really well, both for the fund, but also for the planet. I would just say one final broader point though on fund structure that I think might actually address Councillor Cartwright's specific point, and that is that the fund is currently managed. Your fund is currently managed as effectively as a single pool. So all the liabilities get thrown into one pot, and all the assets get thrown into that pot. And our challenge is to choose a single investment strategy that will deliver the best possible funding outcomes for members over the very long term. Fund is not structured to offer choices to members on how they want their investments to be invested, and in particular to offer a fossil fuel free investment strategy choice alongside a normal investment strategy choice. Why not? Because offering that choice and running multiple investment strategies is much more complex, likely more costly, and also by splitting up the liabilities, you are losing some of the benefits of pooling risk, which is the whole point for creating pension funds. It's to pool the risk of living a very long time. So that's one of the reasons why everything is pooled into a single pool. Hopefully that.
So Philip, I mean, just to be clear, then the net zero carbon target is being exceeded at the moment. Is that correct?
You are. There is a trajectory towards achieving net zero carbon, and you are slightly ahead of the trajectory.
So we've got points 28 and 29 on the paper that talk to that exactly. So the result of our current strategy has been fairly significant and has reduced our carbon intensity of the fund from the 2019 baseline of 164 tonnes of CO2 per $1 million of revenue to 102 tonnes of CO2 per $1 million of revenue. So that's a 38% reduction in the 3 or so years since we started on this journey, or at least created the baseline. Now our target is a 50% reduction, and that date that we need to get to that 50% reduction is 2030. So we're 38% of the way there. We've got a remaining 12% to go. There's a lovely graph at the top of page 31, which shows roughly where we are. And you can see where the line intersects the 50% line there. So we'd expect about 2027, if we carried on a trajectory which is kind of flat from here to 2030, to meet that 50% reduction. So we should be early. It's testament to the work that we've been doing since 2019, and we talk about that point 26, where we talk about the first movement that we made, which was to from LGIM's passive funds to LGPS Central's All World Climate Multi-Factor Fund 2020, where we moved 0.7 billion, and we moved 0.7. It's proved to be a fairly popular fund with the other partner funds. Most people are invested in that, so that this is the tilted method. There's about 4 billion in there now. Partner funds have obviously voted with their feet and moved toward that. And it's programmed to deliver, fairly large improvements on a variety of metrics, and those metrics are shown at the bottom of page 29. The fossil fuel reserves are 70% below the index. The carbon emission intensity, so this is what we call the weighted average carbon intensity, is 72% below the FTSE All World benchmark. And there's a couple more there, green revenues, etc. So it's proved to be a fairly popular fund. And then in November 2023, we added 3.5% of our total equity to LGIM's Low Carbon Transition Fund, which does something similar, aims to have a 70% reduction in carbon intensity versus its benchmark, but also a 7% reduction per annum in line with the Paris Aligned strategy.
Thank you, Bullish. Now, Mr. Bill, you've got this.
Earlier on, we were talking about levelling up, and I used the word cynical. Could I have that corrected, please? I intended to use the word sceptical about, didn't want that to be on the record. Earlier on, Chem, if that could be, if I could correct that, I would appreciate it. When you realise you've said something which you choose the wrong word at my age. And then in your preamble, Chem, to this, you said that we had a responsibility to look at wider social and ethical considerations. I would hope that would include environmental.
Oh, absolutely. Yes. Environmental, social and governance issues, yeah.
I have no criticism of our advisors, our officers, or anybody else. But what concerns me is that we can actually see climate change happening in front of our eyes. It's awful, and it's almost too dreadful contemplate. So however hard we're working here in our own small way I think we've just got to go further. It's not just ourselves, but everybody who's involved in investment considerations and where we go from here. We've just got to do more. We just can't let things. In 10 years' time, when we see the situation has deteriorated across the world even more, we look back and say, well, did we do the right thing today? So I really am very much in support of Martin's move here to, if it's only requesting our colleagues in Central to concentrate on this, because the background information I've been supplied with has given me the indication that other partners in Central share the same concerns as we do. So all I think we're asking for is that we actually look at what is possible and see what we can do to fulfill our responsibilities to future generations effectively.
Thanks, Mr. Bill. I think they have looked at it quite before. Yeah. Okay.
if I take that and perhaps address Mr. Bill's point as well at the same time. I haven't got an exact figure for you as to how much it would cost to set up this fund at Central, but setting up any new fund, particularly one that has multiple underlying managers, is a significant undertaking in both financial cost and effort, which would displace effort from what Central are doing on this issue, which we have asked them to do, and is part of your responsible investment policy, and is something that absolutely the fund should be doing and will need to do more of, is engaging with investment managers that are working for you, and making sure that those investment managers are engaging rigorously with underlying companies on their decarbonisation plans. Making sure that those plans are credible, kept up to date, and crucially that they're delivered. Now, that whole engagement process is in itself extremely time consuming. But it is something that managers and companies should be doing, and it's something that the fund can strengthen. And we make some recommendations in the paper on a number of things that could be done to strengthen that engagement on a whole variety of ESG issues, but particularly climate change. So what we're absolutely not disagreeing with the point that this is a grave problem for society. We're certainly not disagreeing with the point that more needs to be done and more will need to be done in future years. It's simply a disagreement about what can best be done to move the fund forward and move the planet forward. And our proposal is focus on remain invested and focus on engaging with those companies that need to decarbonise, doing it more rigorously, doing it being more tough about it, rather than creating expensive parallel fund structures.
Thanks, Philip. I mean, am I right in thinking that even if we did go down the line of a fossil-free investment, we could end up with investments actually more carbon intense than we had before?
So there are a number of the fossil fuel-free funds that are being run, and there are a handful around the market, including one at the London CIV, for example. Bullish discovered that actually those funds have higher greenhouse gas emissions than the funds that you're invested in. So it could be counterproductive for the fund, and I think equally importantly, it could make no difference whatsoever to the planet. So what tends to happen when funds divest fossil fuel companies is they tend to get bought by other investors who are not as responsible investors as you are. And I'm not convinced that's a good outcome for the planet.
Thanks very much. I think we're all really on the same track of what we want to try and achieve. In fact, our strategies. Oh, right, Mr. Cartwright.
I'll go last.
Well, let's hear you now.
I'll go last.
Thank you very much, Chair. Okay, I think you've given some really compelling comments within this meeting. Use phrases like a number, a handful. We're performing better, you said, than Borders Coast earlier. All we're asking is to prove it. give us the numbers, give us the data, put it in the papers. I know that you've made an argument that we shouldn't necessarily be looking at other funds and other pools. Post earlier, that helps me as a member of this committee to understand. That kind of plays well to my learning styles, and I'm not being given the data or the information to enable me to absolutely believe what you're telling me. And that's because you haven't got the information to hand, and that's fine. So put it in the documents. And I'm requesting that. It's just a polite request. The other thing here, I think there's two other things for me. One is about transparency. I think all we're asking here for is that members who are paying in to get a decent pension have a level of transparency, and this would enable greater transparency and potentially choice, which ain't a bad thing in our society over the last, isn't seen as a bad thing in our society. Offer customers choice. We are saying in this case we don't want to offer choice. And I think because there is good reason for that, which is fine. And the final thing I'll talk about, which is what Vipul plays to, was this quite widely discussed concept of discrimination against younger scheme members, which has been tested, and people are looking at testing legally. And there is a very good argument that, dare I say, people like Vipul are being discriminated against as we speak around this table, because the risk to their pension is so much greater than the risk to older people's pension. And I feel really uncomfortable, given the lack of information I've alluded to earlier, in saying to younger scheme members, let's just go along with this, even though I don't feel like I've got the information in front of me.
Okay. Thanks, Adam. Declan.
So I just might come in on a couple. I think there's a danger we're losing what the original kind of motion was. The original motion is about the approach to the type of data.
I'm not losing anything. I think my point is, I talked about the transparency that this would enable, and the choice that this would enable. Particularly, I'm talking about younger scheme members and the risk to their pensions. And this would help them and us better understand. Given better data, I might change my mind. I haven't got that data.
Okay, Declan, I can make the point that you've got to bear in mind this is a defined benefit contribution scheme. The choice of the decisions around investments are made by the sort of trustees of that sort of scheme, which is this committee or the delegation to the investment subcommittee. Individual members don't get that choice. It's really clear that's just how a defined benefit scheme. They want that individual choice. Move into a defined contribution scheme where they take all the risks and rewards of those investment returns. It's incumbent on this committee to take that balance between the sort of monies that have been invested in to assure that there is the pension to be paid in the future, and ultimately that falls back onto the employers who sort of underwrite this scheme. So that's the role of this committee. It's not a choice to individual members. We have to be cognizant of what individual members' views are. Ultimately, we've got a fiduciary duty that we've got to meet. Going back to sort of the original motion. The original motion is about an approach to how we decarbonise as a fund. At the moment, the net zero climate strategy for this fund sets out the rate that we decarbonise. That's not the information that's been put forward. That's why there isn't a lot of sort of analysis comparing the rate of decarbonisation proposals. It's more the concept of how we. We just need to be careful that we're not looking for more than there's actually in the advice in the paper.
Okay, thank you, Dan.
First of all, sort of backing up Adam, Philip made a very interesting point about Central has done better than Border to Coast. Is that right? And within that, I'd be very interested where that data is within that. If you could provide that to us, that would be very helpful. I think that's one thing. Second point is you talk about sort of weighted indexes that some of the PS Central have, where they exclude thermal coal. Could not we ask LGPS Central for the index fund to exclude thermal coal? Not talking about all fossil fuels, which is big numbers and controversial within that, which we can consider separately. But could not the index fund, because there is no reason to have any thermal coal investments anymore, The third point is, I understand the difficulties about. Yeah, I understand the points of talking about the difficulties about setting the fund up. Okay, although talk about with other members LGPS Central, but is there an option for us to invest in somebody else who's set up a fund already that's fossil free? I'm not saying whether we should invest in it or not, but is that an option?
So I'll do the last bit first. The investing in somebody else's fund is inherently full of issues at the moment. You know, shareholder agreements, and nobody else has done it yet, and legals. So it's talked about, but in the scope of progressing pooling, it's one of the avenues that may need to be considered in the future, alongside, you know, merging pools, etc. But it's nowhere near being fully formed or thought about yet. Yes, we can do. So transition costs when moving between funds are hugely expensive, and at the start of a transition, we'll appoint an advisor. Advisor will tell us what the expected cost would be. Put things into perspective. In December 2020, we moved about 0.8 billion to Central Climate Multi-Factor Fund from LGIM, and the expected cost was circa 18 million. With a huge variation. You know, the longer you are out of the market with 0.8 billion, the worse the market could move against you, and that 18 million can turn into 36 and 54 quite easily. So transitions are taken on really carefully, just because of the costs of getting it wrong, and certainly you don't want to be doing it often on the basis that you're just incurring huge costs.
Okay, thanks very much. So, Mr. Clark.
Yeah, can I just come back in? Could you just explain to me again the point you were making about the risk associated in terms of returns with setting up a fossil-free fund, not having the kind of pooled, the only pool, the fund that we've got at the moment. So, as I understood it, what you explained was it's going to be very costly, and it was also going to be risky in terms of the level of return, and therefore there's this choice bit. Whose choice were you talking about? So have I made that clear?
Yeah. Yeah, sure. Your fund is structured in such a way where all the members, all the liabilities, all the assets get thrown into a single pot, and therefore key risks, investment risk, and longevity risk are all shared. If you offered members a choice of investment strategy, you would essentially be creating two funds, one of which would be a smaller fund for those members that wanted to invest fossil fuel free investments. The investment risk and the longevity risk in a smaller fund would be higher than in the large main fund. That was the point that I was making. But the flip side is that they would have a choice that they may or may not be qualified to make.
Okay, sorry, fundamentally, they can't make that choice because we're
yeah, just hold on a minute.
So we've got a fiduciary duty as a committee, and we can't just give that choice to individual members. That's the big issue. You can't just let people choose, because they could choose to invest in anything. Fundamentally, that risk falls back on the employer, and we need to make sure that we're finding that right balance between sort of the needs of the pension funds and the demand on them. Yeah. That's the responsibility of this committee.
So Declan, just a question. Can members come out of the LGPS and go into their own defined contribution scheme if they feel that strongly about it?
As employers, we have to offer the LGPS. If employees pull out of it, for as far as I'm aware, pretty much every employer in sort of the Leicestershire Leicester City area, they don't offer a different defined contribution scheme, so they wouldn't get those employer contributions. So it is a bit of a take it or leave it, but they're not mandated to be in the scheme.
They're not mandated to be in it, but that's fine. Mr. Denny.
think we're all of one mind as where we want to get to. I'm a lifelong environmentalist. But what I don't want to see is that deflecting millions of pounds to find a different avenue to get to the same end result. I'm confident that what we're doing is getting where Martin and others wish us to go. I think we're going around in circles about mechanisms and not about end results.
I totally agree. I think we all have the same end objective. Mr. Bill.
Yeah, I was interested to hear from Nick about thermal coal. That reminded me, just a handful of years ago, we were arguing the case for coal mines in the Vale of Beaver in this building in order to find employment for the miners of Colville whose work was, mines were being closed down and we were looking for new mines. The world has changed. It's changed so rapidly. Could I just ask a specific question though? You've told us about discussions going on within Central. Picking up Adam's point, it would be useful if we could see some record of these discussions. For example, the sort of things that I'm just curious about is, when this body gets together, does it consider whether it approves of North Sea oil licenses, for example? That is, that if we're talking, if you are engaging with Shell and BP and all the rest of them, do discussions take place at that level? Say, well, quite frankly, we're not too keen on what you're doing, drilling in the North Sea, because that sends out the wrong messages. Do discussions of that nature actually take place?
Your managers will do engage with Shell on precisely that topic. And the reason they're doing it is to signal to Shell that capital providers want to see Shell transitioning to a low carbon future. And they're also doing it to make sure that they think Shell has got a credible decarbonisation plan in place, and that Shell isn't going to be left holding assets that are worthless when the world eventually has to stop or largely stop using oil. So those discussions that do take place, those discussions are reported. They're reported in very dry, high-level statistics on how many meetings have been held with companies and how many votes have been made on different topics. And one of the ways that we are suggesting that the fund try and improve engagement is improving that reporting. So it provides you with greater insights of what's being discussed with underlying companies in relation to climate change and what outcomes have those discussions led to.
Okay, thanks, Mr. Bill. Right, Mr. King, I think you wanted to talk.
Yeah, thank you, Chair. Very interesting discussion. But I think the recommendation from Simons Robertson as to the way forward, I think is, in my mind, absolutely correct. And Declan's made the point. Our role is we have fiduciary duty as appointed members of the Pensions Committee. We're not here to represent our own personal political viewpoints, whatever that viewpoint might be. We're here to ensure that there's sufficient money in the pension fund to ensure that when employees wish to draw down their pension according to the regulations that apply, there's sufficient money to meet the liabilities of those pensioners. And currently we are in a fortunate position that we are positively funded, i.e. we've got more, according to the last actuarial valuation. However, that can change. And a few years ago, we were underfunded substantially. So, and contributing employers had to, and still have to, still are making substantial payments to the fund. As Declan just mentioned, if if an employee decided not to join the Leicestershire, the local government pension scheme, which they're not compelled to do, they can go and make their own arrangements, and then they can choose which type of fund or what name badge on a fund they want to invest in, as we as private individuals can do. But when we're in a pooled investment fund, and we're in a fund like the local government pension scheme, having individual funds and saying, member X, you can invest in that scheme. What about if members did invest in that scheme? And what about if members then their benefits were short and those benefits couldn't actually be paid out because there wasn't enough money in that pool? So there's a lot of what ifs there. But what if that fund, for whatever reason, in the long term, doesn't deliver the level of return? Then how does that then work with employers? Because employers are putting in the biggest contribution by far and away to employees. So then there's a huge risk riding on employers. So it could be that if you've got, say, half your employees went into this hypothetical green fossil-free fund that you're mooting, and then the other employees stay in the main pooled fund, then how does that work? So do employers put in 35% for the ones who are in the main fund, but do they have to put in 60% for the employees who are in the fossil-free fund because it doesn't deliver? Or is it vice versa? I don't know. I'm not a mathematician at that level that could compute that. But the level of risk associated with that is so massive that it would be irresponsible of us to go down that route of having that sort of fund. So the safest route, in inverted commas, is to stay, to my mind, is to stay in the, to stay as we are with this investment strategy that we've got, which is showing at the annual reports that we've had on this. And we also did consult, as I recall, with the scheme members only in the last 2 years. Was it 2 years? I've been on this 2 years, so it's in the last 2 years. And the members' feedback we received from the members of the scheme who responded was that they were content, or they were supportive of the strategic direction that the fund is taking on carbon reduction. Now, whether I personally agree with that or not, Councillor Cartwright, it doesn't matter. It's not relevant. What the point is that that's what the fund is moving towards, and our role as quasi-trustees is to make sure the fund is going to have sufficient money to pay out against the liabilities, and make sure that we're not in the position we were a few years ago, where we were seriously underfunded and we didn't have enough money to meet all the liabilities, and that liability then fell onto employers, so much so that if some employers are contributing vast sums of money, which is then taken away from services which you, me, in our other role as councillors or other representatives would wish to be spent on services in the day job. And that's a problem at the moment, because it's something we can't get out of. The law is local government pension scheme. We have to provide it whether we want to or not. We haven't got to get out. We can't offer a different scheme to employees that are mandated under this scheme to belong to it. And that's problematic at the moment.
Okay, so I'm going to take, thank you, Mr. King, and take two more questions, one from Mr. Grimley, one from Mr. Booth, and I'd like to hear from Mr. Cartwright. Right, because I don't want to keep going round and round in circles.
Okay, thank you, Chair.
Mr. Limbaugh, let's take Mr. Limbaugh first. Okay. Yeah.
Chair, I just wanted to flag, just to think about where we are at the moment in terms of outcome of the at this particular time. Yeah. It's not being dismissed. My question is, steps, having heard the debate, and really points to and for and against, and quite rightly about making sure the pension fund is I suppose it'd be useful to understand what's our commitment in terms of that, because that will continue to remain an issue. Not fit at this point in time. So what's the next steps?
Okay. Right. So, Mr. Booth, then.
I think there's an advantage of having scale within the fund as one particular fund. But coming back to my query behind that, is there any way we could ask other funds within LGBS Central, and is it possible to change the mandate for the Legal and General to exclude just thermal coal?
Well, look, I'll ask officers. There's some question of what's the next step. Well, the motion is here, and as far as I'm concerned, we either take it or we don't. I mean, we have been round, and I mean, the irony of it is, I think we're all on the same sheet, really. We all want carbon reduction.
No, I'm just asking a specific question to Philip.
But again, we're taking specific topics, which seems just not really relevant. Go on.
If you're happy, I can deal with it. That particular point very quickly. So yes, of course, the partner funds in Central could discuss whether they would like to apply a selective exclusion on thermal coal from funds that are run by Central, and I don't know what the result would be. On Legal and General. Legal and General run pool funds with enormous numbers of investors, so you cannot really ask them or tell them to do anything. What I would say is that you're actually invested in two things with Legal and General. One is a traditional market cap fund, where the stocks are weighted according to their market capitalization. And the second is a fund called the Low Carbon Transition Index Fund, where the stocks are weighted towards good companies with low emissions and low fossil fuel reserves. I remember we recommended going into that last year. That fund already excludes thermal coal. And one thing that you could do, and we did say in the recommendation last year that we should consider this, is that over time you could progressively sell out of the traditional passive fund, but more in the Low Carbon Transition Index Fund. The only reason we didn't say do that straight away, that Low Carbon Transition Index Fund is a new strategy, relatively unproven. We're not sure it's going to work in financial terms. So we didn't want to put all your capital in that one. But that is an option you have going forward.
Okay, thanks very much. So now I will take Mr. Grimley and then Mr. Cartwright. Sorry? Well, the next steps, as far as I can see, is actually to vote on the motion eventually.
So I think there's an interim there, which is we've left it open, haven't we, to say that not at this time. So what we do have is a mechanism where officers meet the other officers from the partner funds regularly, once a month at least. The minute that it becomes obvious that there is appetite for something like this, then obviously, Central will be amenable to something.
Yeah.
So I suppose that is the next steps.
Thanks, Boris. I think that's very clear and sensible. So finally, Mr. Grimley, some words of wisdom from you.
Thank you. Declan rightly points out individuals have their own private pensions. I have my own private pension. I take a high risk strategy at the moment. I wouldn't want to be doing that with other people's money, to be quite honest with you, because I do have the duty of care on there. I mean, if Central did have a fossil-free product portfolio in the future, we could look at how that is performing in terms of investments. Then yes, certainly I'd be interested in looking at that. I think it's the way forward, possibly in the future. But once a product is there, and obviously I pick up you are having discussions with other fund people. So I mean, if there's something in the future that was there that was performing, I think that's something that's certainly be on behalf of the people interested in looking at.
Okay, thanks very much. And finally, Mr. Cartwright, thank you for your patience.
Thank you, Chairman. Just a couple of points of clarity and then a bit of a further explanation, and then I think we can bring this to a head. So I take my obligations under this committee very seriously, and I would not wish to in any way impact on any of the funders or any of the costs for the fund schemes in achieving our objective. That said, only me in this room knows the rationale behind why I bought this in the first place. And there has been some misunderstandings, which I'm not going to go into, but I'm just going to explain the rationale behind it to hopefully have one further go at getting this through unanimously with support, because I don't believe it's controversial, given the explanation I gave earlier to you, Chair, which I won't repeat. We've got to remove ourselves from this. This is not at this moment about us. All of the people that all of the companies that we have investments in are, the vast majority are looking at their climate credentials, rightly so, and it's not for us to influence them. But I'm sure the vast majority of those that are, such as councils and even the county council, would welcome the opportunity to be aligned to something which delivers that aspiration. That was the motive behind it, nothing more, nothing less. So taking that as being literal, then I wouldn't see that they wouldn't want to go into this fund. But I do accept your explanation and the significant concern about having a specific fund that actually says that and setting that up and all the costs associated with that. I don't support that entirely, because they're paying costs to the fund they're already in, and those costs would move over to the other fund. But I don't want to get into the debate of that. But what I can help you with, Chairman, which will probably bring us to a satisfactory conclusion that everyone can support, I accept that in bringing this motion with the further advice that's been sought thereafter as a result of the healthy debate, which I welcome, is that we may get to this in the future. And I'm sure it will happen, and it will happen in my lifetime. But let's not worry about that today, because we can't. But what we can do is we can say, as an interim measure, we categorise all our investments, such as infrastructure and all that kind of stuff. We could add some clarity without costs. And this is where I'm going to amend the original proposal that I made to actually state that in the interim, while we continue to look at this, we amend those categories. So there are two categories. There's this: if you're in cement, you're in cement. So you're in cement. But within cement, you might be a fossil-free company, or you may not be. So we just need two categories that are sub-indexed within all of the funds that say it's either fossil-free or it's not. And then those companies that are may welcome being aligned to that. And if you're not, you can't be aligned to it. You know, if you've been done for speeding, you can't deny you've been done for speeding. So it simply gives that data then, it gives the category, the subcategory within the other categories that they're in, that makes it clear whether they're currently fossil free or not. And then over time, those parameters will move, won't they, as they achieve their objectives. But that costs nothing other than the setting up of a category within all the subcategories that makes it clear to, because I've never ever, I mean, the assumption's been made that individual members choose which category they go into. I've never advocated that. All I'm asking for is clarity, so that anyone looking at the scheme can actually see firsthand, without having to drill down into those individual companies' data details as to whether they're not. I don't think that's controversial, Chairman. So I'm going to amend this proposal and look for a seconder to say, thank you for the report as a result of the original motion. I welcome that it's being kept under review and may be considered in the future. But for now, we establish a mechanism that just puts a category against each company that's aligned to the pension fund as being something we invest in, as to whether they are or aren't pregnant or not. Thank you, sir.
Thank you, Ms. Cartwright. Now, Ulrich, if you would like to outline the complexities of doing this, and no doubt have bulk reports.
It's obviously complex in the sense that fossil fuel tag, if you like, isn't available as one of the markers against a company. But notwithstanding, we do report on fossil fuel exposure once a year. It goes to the November, last year it was 1st of December committee paper, so it's the climate risk report, and within there we do tally up and work out what the fossil fuel exposure is, and we can break that out by company if needed, but yeah.
Okay, so I think that answers the question really, and we will do that this year. Yeah.
Can I second what Mr. Cartwright's put forward on the basis that it is breaking it out by company?
Yeah, Bhulesh, we already have that report.
Yeah, the data sits with LGPS Central, so we'll have to check with them what breakdown we got. We haven't generally asked for all the companies. There's literally thousands that make up all our listed equity exposure.
Yeah.
That's where we're focusing the sort of, I suppose, the climate sort of change, the sort of engagement type work, because there's how many equity sort of folders we've got, but it is in the thousands, and that sort of full list. And so at the moment, like Bhulesh says, it's all about sort of using standard international definitions. That's what we follow on that sort of range of measures, and then publish the top 10. If we go down the fossil fuel free mark, there's not going to be many people on that list because there's not many companies that are actually truly fossil free. It's sort of, it's still quite a, it'd be a rare thing.
Okay. So really, the advice is that we've got a report already, and this isn't really going to add anything to it. Is that correct?
I think the advice is to look at it, and look at the detail I can bring back.
No, look, no, hang on, Adam. No, you're telling me what the advice is. I'm asking the officers.
We take the report each year, and part of that is looking at the sort of the measures that are available.
Yeah.
Part of the focus at the moment of the fund has been to sort of increase the breadth of those measures. So at the moment, it's very much focused on equities, but sort of, and Bhulesh has been doing work to sort of bring sort of corporate bonds and things like that. And so we're getting a broader coverage. Now we do look at what's available. Government, we're going to sort of set out some sort of standard definitions, but they're backtracked from that. So we kind of, it's not an area where you want to set up too much reporting. So the preference would be to wait until we sort of get closer, probably this sort of September committee, come back then and say, this is what we're going to report on in November. And then we can sort of, I suppose members can sort of input into sort of what's actually being proposed, might be the sort of the easier way forward.
Yeah, well, that seems sensible to actually have a look in September and see what we're going to report in November and see if we can get as much detail as we can without going over the top. Yeah. So that's what the idea is. So we have a motion, we have a seconder. We also have advice from the officers that said we ought to review this in September and go. So Ms. Cartwright, are you happy with Declan's suggestion?
Nervous. Providing the assurances are given, then yes. But nervous because I don't want to get to September and find it's been diluted further.
No, I understand,
and that's no disrespect. But I'm just trying to get to the original objective, which isn't political, by the way.
Yeah, no,
just the clarity that I talked about.
Well, look.
So on that basis, yes, but I want it in that this has to come back as that in September, not some diluted version or changed or amended version as we seem to have ended up with today.
Okay, thanks, Ms. Cartwright. Right, Declan.
Just quickly to try and give Mr. Cartwright a bit of assurance. You can maybe go back to sort of the November reports, have a look through the measures that we report and come back to us with sort of the specifics where it doesn't meet what you want. And then we're kind of working on, I suppose, something tangible in front of us as opposed to sort of too hypothetical. So if we could actually do that over the sort of next couple of months, just be really specific about where the measures fall short of what you'd like to see. It means we can come back with something with a bit more substance.
Let's arrange a meeting. I'll meet with them outside.
Okay, that's fine. Okay, so but on the idea that we have a look at the metrics in September and move forward to November plan, is everybody in agreement with that? Okay, so that's fine. So finally, moving to the various motions within the I'm getting hung up on.
No more motions.
No, I can do plenty of motions if you want, just to sully the waters further, Right, so the recommendations are. I will. So finally, the first recommendations dealing with the recommendations set out in paragraphs A, B and C on pages 34 and 35 of the report in relation to the strategic asset allocation. I'm happy to move these recommendations. Do I have a seconder? Okay, all those in favour? Thank you. Sorry? No. It's paragraph D. We're coming to it, Mr. Bill. We're coming to it. Wait. Don't. So that's dealt with A, B, and C. Moving to recommendation D.
So we've amended the recommendation to say that Mr. Cartwright is going to meet with officers outside the meeting to agree the detail of what will come to September committee on this matter in terms of how we're going to report it.
That's
accurate?
It. Yeah, that's it.
And the further point there, Chair, was to keep the original motion under review.
Yeah.
So not set in concrete, but just under review.
Yeah. So based on the so item D, we've done A, B, and C. Item D, the recommendation is.
So, Chairman, just in terms of that, then, for clarity, so to keep the original motion under review, do we want that to come back as part of this report on an annual basis? Would that be useful, or how do you want to do that?
I don't think it would be useful personally, but go.
As part of the net zero climate strategy, we've always got that commitment that we'll kind of review our progress and how we're doing. So it would start to either become off track or other opportunities present themselves that give us a better way forward. It'd naturally form part of that. Yeah. So that would be the preferred approach. That's formally reviewed every 3 years, or if there's a trigger that happened beforehand, which, like I say, could be we're not hitting our targets, or a better option comes forward.
Okay, well, I mean, that makes sense. I mean, ironically enough, I think we're all on the same path in trying to reduce carbon emissions.
So you want it to be reviewed as part of the net zero strategy, which is every 3 years, unless there's a trigger that happens before.
In terms of that trigger, we do report against progress every November, so it'd naturally come up as part of that.
Okay, so that's fine. So the final thing is note the advice now provided by the fund's investment advisor, Hymans Robertson, regarding the proposal to require request LGPS Central to establish a fossil fuel-free fund, and agrees with the recommendation not to proceed with this proposal at the current time. So I propose that. Seconder? Yeah. All those in favour? Yeah. So that is passed. And then finally, agree the recommendations put forward by Hymans Robertson as detailed in paragraph 43 above to implement as part of the fund's net zero carbon strategy. I propose that. Can I have a second?
Shall I second that one?
All those in favour? And that's passed. Okay, so now moving on to finally, we are now on to the item 7 draft responsible investment plan on pages 109 to 122, which is a really clear report, but I'm going to ask Kat to present the report, please. Kat, go ahead.
Thanks, Chair. I obviously spent quite a lot of time on the last item, so I'll kind of just go through this quickly. But this is the annual responsible investment plan that the committee receives. So this is the 4th iteration, and this builds upon past plans, best practice, the fund's investment strategy statement, the net zero climate strategy, and then also any kind of recommendations from Central's in-house responsible investment team, as well as the climate risk management report that came to December, which had a few recommendations how we can improve kind of disclosures, especially. So our the Appendix A sets out the planning in detail, but just to kind of highlight, especially with what's kind of been discussed today. So we'll have the continuation of quarterly manager presentations. So it's a really good chance to question managers on their environmental, social and governance approaches, and of course, fossil fuel exposure if they hold them. We'll have a deeper dive into stewardship as part of the March meeting. So that kind of follows on from discussions that we're have at the December meeting. And then we can, LGPS Central will be in attendance, so they'll talk through the new and revised stewardship themes, kind of talk about the new kind of performance indicators and how we can better report on outcomes of previous engagements. We'll also have a continuation of the review of the fund's investment managers' approach to climate risk. So we sent for the first time a questionnaire to managers last year, and then we kind of did some high-level reporting in December meeting, but we'll look to expand that towards kind of more stewardship activities, as well as maybe other environmental, social and governance areas, and kind of the areas that Hyman's recommended that has just been approved in terms of how we can kind of better or kind of encourage and better report on engagements around fossil fuel companies and kind of really carbon intensive companies. We'll also have the Task Force on Climate-related Financial Disclosures reporting in June, which takes into account the metrics from December's meeting. We'll look to revise that to make it as easy to read for scheme members as possible, to kind of make that a really good resource for scheme members that are concerned potentially about how the fund is invested. And then we should be able to circulate a shareholder day and RI summit for LGPS Central. And we'll circulate that as soon as we have details, but it's really good for members to attend and kind of get that breadth of information. But I'll just leave it there if any members want to question anything in the plan itself.
Okay, so thank you, Kat. Have any members, having read the report, have they got any queries that they would like to raise? No? Nobody? Right, so the committee has been asked to approve the Responsible Investment Plan 2020-24 and provide feedback on areas of interest.
I'll second that.
Thank you. All those in favour? Before we go any further, I think we have got some areas of interest, haven't we, Kat, already?
Yeah, I've obviously kind of picked up from the conversation, so we'll see where we can put them in the quarterly reports. And obviously, if anything comes up outside the meeting, I can look into it.
That's great. Thank you. Item. The committee has been asked to have a look at the training needs. So it's the Pension Fund Training Needs Self-Assessment at page 123 to 142. Kat, this you're also presenting this report. If you could carry on.
Okay, I'll try and rattle through this. So I guess 3 points to this report. Firstly, providing an update on members' training needs self-assessments. We've had 8 out of 13 members complete it so far, so really encouraging members that haven't yet to do that as soon as possible, because it really aids us in setting out training priorities for the committee, as well as kind of helping you improve your kind of knowledge base in line with that and what we can recommend. We'll also obviously use any hot topics that kind of come up in the year. Second point, so we want to identify training members of training that members are expected to complete in order to demonstrate a suitable level of knowledge and understanding. The training policy sets out why this is so important, but we also have some comments from Director of Law at the end of the report, related to kind of the distinction of fiduciary duty owed to the fund compared to members and officers' usual business, and then the importance of the fund being treated by investment managers as a professional client, and the requirement of the fund to comply with the Markets in Financial Instruments Directive. So we need evidence, training, and knowledge bases.
Yeah.
So currently, training is not mandated. We have mandatory induction training. But other than that, we've just been recommending training to members, and that can happen in a number of ways. So as part of these meetings, after meetings, externally by bodies such as the Local Government Association, and then kind of investment managers and Hyman's. And then we also have the Hyman's modules online, which I think offer a really good flexible solution for members to access this training in bite-sized chunks, and kind of demonstrate that with a questionnaire at the end to show that they've demonstrated that they've kind of learned from the modules. We've been asking that members try and complete this training ahead of the 31st of March. This is so it can be as part of the annual pension fund report, which gets reported to September's committee. And this is obviously a public report and important for governance. But we recognise it's not mandatory yet. So we've kind of we're undertaking a review of the training policy, which we'll look to bring back. But really, we're looking for, I suppose, members' views, really. The report from kind of paragraphs 18 onwards kind of talks about options and what other funds have been doing. We think a good middle ground would be mandating the Hyman's modules training within a reasonable time frame, which we can send to members and say, these specific modules are really helpful for the next meeting. And we can kind of undertake that in a few ways, either individually or if members want to do it jointly, we can facilitate that as well. Recognise that members, that we don't want to set unreasonable expectations, and you're not expected to become technical experts, and that levels of knowledge will vary depending on experience, and that some members have been on the committee for a number of years, so have a kind of built up good knowledge and experience through that. But we have to satisfy those providing investment services that the committee possesses the expertise, experience and knowledge required to be capable of making its own investment decisions, and that you understand the risks involved. So continually keeping up with the up-to-date training as on Hyman's modules, I think is really important with that. But I'll leave it there.
Thanks very much, Kat. So I mean, the training is obviously, I think it really genuinely helps understanding of how the nuts and bolts of the LGPS fit together and what various things that we do throughout the year. And I think it's worthwhile, although it isn't mandatory, it's clear that government is moving towards making sure, sorry? No, government is moving towards trying to make sure that members of the local pension committee are. No, this is very nuts and bolts stuff. Actually, it really is basic. It's nothing high level. Nothing. It is just enabling each member to know how it all fits together and how we progress through the year. So it's worth doing. The committee is asked to complete the training needs assessment, if not yet complete, by the 2nd of February. So, Mr. Cartwright, yeah.
Thank you, Chairman. It's a problem that's always struggled with in law, particularly, and that's the word reasonable. How do you define a reasonable period of time? Is that a month, 2 months, 10 months, 12 months before you leave the committee? I absolutely get what Kat's saying, and I haven't completed the whole module, so because I'm relatively new. So, but I do like the proposals to potentially have. I mean, the mandatory training to join it. I've done that and very much welcomed it and got a lot out of it, and I praised them for it at the time on my first meeting, and that was all very genuine. But I really do like the sound of a starter course for new members. And then an interim one for those that don't need to know the basics because they already knew it, and then an advanced one, a bit like your driving test. You can take the test and become a driver, but you could take the advanced driving test if you wish. So I actually like that proposal, part of the proposal. I would like to see that incorporated in it, because I think it would be a softer, more manageable way into it, rather than completing every module and then you're an expert, but in between you're not really anything at all. I'm not being derogative, but I think it helps. To
be honest, Mr. Cartwright, I don't think you'll be an expert if you completed all the 8 modules. This is very basic nuts and bolts stuff, which is, I mean, just working through it will really help every committee member. It's not challenging. It certainly does help you understand. So I think just to complete the training needs assessment by the 2nd of February is really simple. I don't know how many questions there are, but
there's 39, but it takes about 5 to 10 minutes to complete the training needs assessment. And if you need a paper copy, we can get you one as well.
Okay, Mr. Denny.
I think these tick box training things are easy to tick boxes and you don't come out with a great deal of knowledge.
Yeah.
I think we gain far more by having a training session here. Those of us at each level who feel we need it. Because a lot comes out of the debate and the questions which arise and the discussion amongst the members themselves. So I'd like to see instigation of some sort of training events. Yeah.
Yeah. Okay. Well, first of all, I think would that be possible, Bula?
So we've ran some in the past before, and I think we ran one 13th of June last year. It was in here actually, and I think it's webcast, so it's available to view again if needed for the for the newer members.
Yeah. Okay. So I mean, sort of base block is to do what we say in this committee. Mr. King.
Yeah, thank you, Chair. As I mentioned earlier, I was, and it's mentioned in the report, I attended the Local Government Pension Scheme Conference last week, and that's right, yeah, that's right. Very well attended conference, actually, several hundred people there, and which is very interesting. But one of the issues that was talked about, which we haven't touched on in this meeting, is the fact that the pensions regulator released a new general code on 10th of January, which is expected to come into force on 27th of March. It's just I've got my crib sheet here. So I'm just wondering if the officers can advise, will we get an update as to what implications that has for us as, if any, for members of this committee, pension scheme committee. And also I understand the government, the pensions regulator is looking at how to strengthen training of members of the pensions committee and pensions board going forward. And actually, whilst you've just said, Chair, and one or two other people said, well, you know, I'll do it when I want and all that sort of stuff. Actually, government's moving the opposite direction and is actually saying you've got to do it, and if you don't, you can't make decisions. I can see that coming down the pipe. I'm just wondering if we're actually, and I don't understand why we're going down this route, but so I think we do need to be mindful the direction of travel is the opposite way to what some members have just expressed, including myself previously. So I think we've got to be mindful of that. So I'm just wondering about this pension code thing. I didn't go into any detail, but I'm just kind of querying whether it does make any difference to what we're doing. Thank you.
We'll bring something to the next quarterly meeting just around the sort of, I suppose, the general updates in the LGPS, and pension regulator stuff can be one of them. To be honest, we're surprised it hasn't come in sooner, because it was actually Hyman's in a different capacity, did a good governance review a few years ago, and it did sort of highlight one of the sort of the anomalies in the fund at the moment. With LGPS, that pension boards who are more responsible for sort of just looking after the governance arrangement is mandatory for them to be sort of fully trained, but it's not for the committee at the moment. But you're absolutely right. That's been the direction of travel for a little while, and it's just been a bit slow for it to actually come in. So what Kat's proposing is just to start to try and get ahead of that and start to sort of move us on, on that path.
Yeah, I mean, at the moment, this is not mandatory, but I think it really would help committees understanding, and probably be really enlightening for members of the committee to have a look through these Hyman's Aspire models. There is no set date. It is requested that you're at least aware that a record will be taken at 31st of March. But absolutely, as Declan said, I'm almost sure that it is going to be mandatory. And without it, you won't be able to be on the committee, never alone take decisions. So the proposal is that we complete the training needs assessment by the 2nd of February, commit to progressing completion of Hyman's Aspire modules, noting that a record will be taken at the 31st of March for the fund's annual report. That isn't mandating that you do it by the 31st of March, but it's obviously in your own benefits to look at it. And we've had some feedback on the views of the current approach to the fund's training policy, and there are other modules available through training that we've done, and maybe that could be made available. Bullish. Would that be all right if you just guide us where this training is on those, if we could send those out? So I would propose that. Can I have a second? All those in favour? Right, so that is agreed. That is agreed. So that's fine. The date of the next meeting. The next meeting is scheduled for the 8th of March at 9:30. Any other items the chair has decided to take as urgent? There are no urgent items. So that brings today's meeting to a close. Thank you all for your input and a worthwhile meeting. Thanks very much, and I'll see you on the 8th of March.